Welcome back everyone as our earnings review continues, and if we just take a step back and look to see how companies have performed on their reporting day, many of them, a large percentage, have in fact been down, which you could argue has affected investor sentiment. We're seeing quite a pullback from extreme greed just 1 month ago, now into the neutral, and it's also showing in today many companies have reported, and for the large part we are seeing a lot of red. Perhaps surprisingly, we're seeing Apple up 3%. AMD also looks to have recovered yesterday's drop, but we want to identify 5 companies that are crashing today. We're talking very large drops, with the first one being Fortinet, down 25%. Now, each one of these 5, we're going to do a very high level look at their earnings. We're also going to run through our own valuation and discuss whether it could be a buy, hold, or avoid. Now, this one up 29% over the last year. Year to date, though, down 24%. Vast bulk of that has been pretty much today, where they've had 1 quarter of their market cap wiped out. But over the last 10 years, if we do zoom out, even with this drop, they've still outperformed the S&P, up 671%, and they're trading right now very close to a 52-week low, which sits at $68. Now, only Seeking Alpha hold this as a buy rating. Wall Street not far to 3.5 to flip this into a buy. One thing though that does hold true with this company is the valuation is very rich. Forward P sitting around 38. Question is, after this drop, does this warrant taking a closer look? Straight away into their earnings report, where we get an EPS beat, revenue pretty much in line. Year over year comparative, they're up double digit. Earnings per share up 10% from the previous quarter, revenue up 6%. And we can see Forbes released an article today wondering whether or not, if this is around the $70 mark, investors should consider buying this, and very quickly. Now, the main reason, even though we did get to see a double earnings beat, is that their Q3 guidance was lower than expected. This is a general theme we are going to see right across the day. Many companies performing double beats, but we're seeing their guidance being lowered. And Forbes believe this sell-off does look very drastic, very excessive, and perhaps one Mr. Market is giving you a phenomenal opportunity to consider adding. And it's worth highlighting that this company has only continued to improve on its capital efficiencies. We see the ROIC, the ROA, the ROC, all of them moving in the right direction. And remember, as we will come onto it, typically we want to see a minimum of 10%. And actually diving into their metrics, which we will do for each one of these 5, free cash flow per share, consistent growth year on year. That is exactly what we get here. It would be difficult for this image to be even more perfect, where we see growth year on year and expected to continue over the next 12 months. Yes, we are seeing sales growth a little bit inconsistent whilst double digit, bit of a slowdown from 2022. Nonetheless though, 12% in 2024, 14 on a trailing 12 month, does look fairly attractive, and that's also something we see when we zoom out and look at the sales. Over the last 10 years, they've gone from 1 billion, now sitting at 6. The other thing that they do, yes, they don't pay a dividend, unfortunately, for those investors that do like to focus on that in particular, but they return excess cash through those share buybacks, something we've seen gather a bit of pace over the last few years. Perhaps with the drop in the share price, we may see the announcement of a nice share buyback program. ROIC, as we highlighted earlier, looking very strong, 55% in 2024, 50 on a trailing 12 month. These are some very good signs that management are able to effectively allocate their capital, and we can see margins equally as impressive. Yes, revenue has grown. That is one criteria for a high quality company. The other one is the improvement in their efficiencies. That is what we're seeing, 2% 10 years ago, now sitting at 31. Free cash flow, you can call them a free cash flow machine. Very consistent, sitting around the low 30s pretty much over the last few years. The other thing that we want to really flag, and maybe our favorite thing, net debt to EBITDA over the last 10 years and expected over the next 12 months to stay at 0, meaning it won't even take Fortinet 1 day to pay off all of their debt net of cash on hand. absolutely phenomenal balance sheet. The other thing we have to consider, as most of these do trade at a fairly high valuation, does the growth justify paying a premium? Now, revenue year on year, 14%, and expected this year 13%, is above the sector in the mid-single digit, but they're growing slower than they have done over the last 5 years. Earnings per share over the next 3 to 5 years does leave a little bit to be desired. 14%, that is pretty much in line with the sector and slower than their own 5-year average. So something just to consider. And before we look at the valuation, we want to see what are the institutions doing, or what have they been doing with their 84% ownership. They sold $5.5 billion in the last year. They bought more at $8.4 billion, and we see them continue that trend in Q2. For the large part, they have been net buyers. They are a lot more bullish than bearish on the company, and if you want to see the reverse of the trend, not too dissimilar in Q3, you'd have to go to around Q4 2023. More often than not, Fortinet is one institutions do in fact love. Now our intrinsic value gets to $118 that we're going to do for each one today. We'll highlight how we got there with the DCF model. Now average growth over the last 10 years at 26%. We've gone 15%, which is more conservative than analyst expectations, where we have a low, medium and high, 10, 15, 20. As always, numbers here are subjective. You can grab a copy by clicking on the pinned comment below. 15% growth rate, 8% discount rate, present value of future free cash flow and terminal price, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, 118, indicating 66% upside. Worth pointing out, on a reverse DCF, we see 7.4% already baked into the growth moving forwards, so that is a good signal as to whether you believe it's undervalued or overvalued. If you believe this is way too conservative, then maybe you see it's undervalued. If you believe it's too optimistic, then overvalued. Full transparency as always at 10%, $84, 18% upside, and if you believe 20% to be more appropriate, 165, 132%, more than a double. So using the middle rate, as we typically do on the channel at $118, we're not done because we always apply an MOS, 10%, execute if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. A buy up to $106 if you believe that to be the case, and then we keep going till it's near the current trading price. And in essence, what we're saying, given the very large drop, you're getting a near 40% MOS. Wall Street themselves, yes, they have lowered their price target due to next quarter's guidance, but on average, $112, 58% upside into next year, maybe one to consider, but do give us your thoughts below. And for those that want to be even more conservative, we can use a 10% growth rate so you can understand the margin of safety applicable. We're talking right now around the 15% if you believe they can only grow 10% over the long term. Last year was at 9. The last few years, in fact, if you go all the way back to 2016, was at the double digit. So this definitely looks like one for serious consideration. Give us your thoughts. Fortinet, buy, hold, or avoid. Now, before we move on to the next stock, just to let you know, we have released our latest free weekly article. We drop one every single Monday morning to your inbox completely for free, where we cover severely undervalued stocks and what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll also be able to gain access to severely undervalued stocks for the month of August. Lots of information for each one, the upside that Wall Street themselves see over the next year, and on top of that, you can grab a spreadsheet of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. The next stock that's been absolutely pummeled today is Crocs, down 27%. Over the last year, it's down 40, year to date, down 30, and longer term shareholders over the last 10 years would have still outperformed the S&P. What a ride that would have been, up 411%. Is trading pretty much at a 52-week low. We're talking half of what it has been at a 52-week high of 151, with both Seeking Alpha and Wall Street giving this a buy. Also factor in with the drop, the valuation will be now lower than 8, so could be one for serious consideration purely on that basis alone. Now again, at a high level, they did have a double beat on EPS and revenue. In the previous quarter, their revenue is up 41%, revenue up 23%. However, on a year-on-year basis, we actually see it in the mid-single digit range. And the reason why we see such a large drop, very similar to Fortinet, weaker Q3, and they put this down to continued uncertainty. What makes it worse is that they've also declined to provide 2025 guidance, which actually makes it harder to really project where this company could be heading in the shorter term. But if we look at it from a revenue perspective over the last few years, we can actually see from 2017, they've been growing their revenue 26% year on year. In fact, June quarter looks very strong when we compare it to the previous quarter. And if we go back to June 2024, we can see there has been growth, but always something to consider with companies like Crocs, whether or not this is something that is going to get out of fashion, or we will see the continuation churn of that double-digit revenue growth. Now, in terms of the grading, they get a D-, not something we want to see, but bear in mind, this company isn't trading at super high valuations, 2% year on year, 2.5% moving forwards, although they have now suspended guidance, which originally was pretty much in line with the sector. You can see though, over the last 5 years, this was one company that was growing at a very rapid rate. EPS projected only 4% lower than both sector and their 5-year average as well. So yes, we wouldn't really call this a growth company anymore, but it could be a value play if you believe that is the angle this company can take. With institutions holding a large portion, 94%, 1.2 billion selling, 1.5 billion buying, and very similar to over the last year, we get this same story in Q2. Institutions buying a little bit more than they have been selling. Reversal of the trend, while Q2 and Q3 of 2024, we see more selling than buying, only marginally, and as we said, more often than not, institutions have been net buyers. In terms of the underlying metrics, well, they have been growing over the longer term, but slowing down, and that is expected to continue into the next 12 months. Very marginal growth expected. And then sales growth, we can see a very, very large slowdown, 67% in 2021, 4% in 2024, and on a trailing 12-month, that slowdown is expected to continue and is really highlighted when we look at total sales. Yes, it's up 4 times from 2015, 1 billion to 4, but we can see over the last few years, it has really taken a hit in terms of the percentage growth. Very similar to Fortinet, whilst they don't pay a dividend, they have been returning excess cash through share buybacks, and similar as we highlighted, perhaps this is something they will start to ramp up. ROIC looking continually very strong, 23% last year, 21% on a trailing 12-month basis, and we are getting a bit of a slowdown in the operating margin in the last few years, peaked at 30% in 2021, now sitting at 25%, but free cash flow does look healthy, 23% in 2024, but understand the market did not like this guidance, not only weak in Q3, but for the full year being suspended. Net debt to EBITDA, unlike Fortinet, we don't get 0 across the board, but looking fairly healthy at 1.45. Typically, we would want to see a maximum of 3 here, so overall, no red flag indicators. Now, our intrinsic value at $151 you may think is quite a lot, but we should alarm you to the fact that baked in right now, if you're adding at this price, is a decrease to the free cash flow year on year of 12.4%. That is something that we don't typically see on the channel, and you may be surprised that we have used low, medium, and high negative. We're talking high -5, low -15, but this really shows the opportunity if you believe in this company over the longer term. So -5%, that is a decrease year on year to their free cash flow, will give you such a large margin of safety. We're talking near 50% at $76. Now, Wall Street, they've had a high price target for quite some time, and we do see it drop to $125. That is still 60% upside into next year. Give us your thoughts on Crocs, whether you see this as a buy, hold, or avoid. But we can also flag for those that want us to use the middle rate, which is something we typically do. You are still getting a margin of safety. In fact, as we keep on going, it's sitting at 20%. That is a decrease year on year to the free cash flow at 10%. Crocs overall though, let us know your view. We then move on to Airbnb, which is down around 10% today, 10% over the last year as well. Year to date, very consistent, trading towards the lower end of the 52-week range. Triple hold right across the board with a forward valuation around the 30 mark. And we can see they also performed a double beat EPS revenue. Remember, we always say just because a company coming into earnings season is expected to have a double beat doesn't mean the share price will reflect a strong performance. And very similar again, we're seeing the same things being mentioned, their guidance lowering. Well, they've come out to say that their growth may not be able to keep up, and they pointed this down to tougher year ago comparisons. Now the growth, another D+, we're talking 10% last year, 10% expected this year. Whilst it is above the sector, we can see slower than their historicals, something the market really wants to see them continue that growth story. And in terms of EPS, 11%, not too dissimilar from the sector as well as their own previous numbers. Now institutions with their 81% ownership sold 15 billion, quite rare to see actually, they bought less, so more often than not they've been net sellers of Airbnb than net buyers. However, Q2 does tell a slightly different story where they were buying more than they were selling. Now previous 3 quarters we can see them continue the trend of net sellers rather than net buyers, so something just to be aware of. Now their free cash flow year on year has been increasing from the negatives of 2020, expected to continue that upwards keep over the next 12 months. But sales growth, something we see with the growth companies quite a lot. Yes, we do get double-digit growth, but it is a slowdown from 2021's 77%, and that's also reflected in their total sales. Yes, growth, very good when you zoom out, but if you just look at the last few years, it is starting to take a bit of a breather. Shares outstanding, unlike the previous ones where we've seen share buybacks, if you're an investor in 2017, they would have diluted your position. However, from 2022, and for newer investors, they've actually started to do the opposite. And ROIC, nice to see it is in fact positive, something we've noted from 2021, 19% in 24, 21 on a trailing 12 month, so no worries whatsoever. And we can say the same thing on the operating margin, 22% on a trailing 12 month, free cash flow, very, very strong. We're talking in the 40s in the last few years. Net debt to EBITDA, as you'll know by now, 0. We love to see that. Something that has held true from 2021, so a very strong balance sheet. Now our intrinsic price, $145, derived from a growth rate of 2%, whereas of today, baked into the numbers, if you're buying, is negative 1% year on year. Even at 0%, there is still upside, so will really depend on if you believe these estimates are conservative or optimistic. But at that 2% rate, you are getting a margin of safety at 20%, around $117. Not that far off. However, as we highlighted, triple hold rating, Wall Street themselves don't have too much faith in this into 2026 at 14%, as we saw previous companies' expectations a little bit higher. We'll also just flag to be extra conservative with no growth into the numbers. There is effectively some kind of margin of safety at 10% at to $115. Airbnb though, give us your thoughts, buy, hold or avoid. And then we move into e.l.f. Beauty, down 13% today, pretty much lost half its market cap in the last year. Year to date, down 24%. Over the last 5 years though, it has massively outperformed the S&P, up 380%, and currently trades towards the mid to lower end of the 52-week range, whilst it has just one buy rating from Wall Street, 4.33, not far off the 4.5, flip it into a strong buy. And we can see again they did perform a double beat, which is great to see, but earnings per share is down from the same comparison last year. And we can see the main reason for this drop as their China tariffs is really hurting this company on the bottom line. And we get to see positive growth at an A, 28% last year, 25% expected this year, well above the sector in the low single digit. And this one historically has been growing at a pretty much fast rate, not too dissimilar from current numbers. Earnings per share projected 16% above the sector at 6, little bit lower as we can note here. Their 5-year at 21. And another one, institutions hold a lot of, 92%, $1.5 billion worth of selling, nearly twice that in terms of buying, but a massive sell in Q2. They have, whilst in the longer term, been bullish. In the most recent period, they have turned to net sellers. Free cash flow looking a little bit inconsistent, although we do see growth expected quite significantly into the next 12 months. Growth story, again, very inconsistent, 77% in 2024, dropping down to 28% last year, 19% on a trailing 12-month basis. And shares outstanding, we can see it, not something we want to see, especially for a company that doesn't pay a dividend. They've been diluting your position year over year. In terms of ROIC, great but not phenomenal like we saw from companies earlier on. Fortinet was very strong. We see here just around the minimum 10% level, and that's something we've seen from just 2023. Margins, as we can see, very inconsistent, 12% in 2025. Ideally, we want to see a minimum of 16% here. Free cash flow, again, lots of inconsistencies. Having said that though, nice to see a declining trend in the net debt to EBITDA, 0.43 on a trailing 12 month, so overall, balance sheet at a quick look does seem healthy. Now, our intrinsic value, $113, is in fact derived using a growth rate of 20%. Last year was up 83%, and what we will flag here, 17.3, one of the higher ones today, baked in terms of the numbers. 20% will give upside, but if we just highlight, if you believe that is too optimistic, at 15%, you actually notice downside of 14. So using 20%, when we take a look at the margin of safety, 10% becomes a buy at 101. At 20%, not quite there yet. So Elf Beauty, 15% MOS. Wall Street themselves, $130 into next year, 37% upside. Elf Beauty, let us know your thoughts, buy, hold or avoid. We'll also, for consistency, show you the different levels. 20% a buy at 90, at 25, $84. We'll then move on to Eli Lilly and Company. This is one for those that didn't see our deeper dive earlier on. This will in fact be very high level, down 14% today, down 20% over the last year, down 17 year to date. Over the last 10, they've still massively outperformed the S&P, up 663%, trading today at a new 52-week low, quite away from their 52-week high, $973, with both Seeking Alpha and Wall Street calling this a buy. Wall Street, again, not far off their strong buy rating, and they did have a double beat, which was great to see. In fact, we're talking double-digit growth, not just year-on-year, but also quarter-on-quarter. And their Mount Jaro now, for the first time in this quarter, has surpassed Novo Nordisk Ozempic, which is great to see for investors in the company. But the main reason why this share price did get hammered, whilst they did have a pill where it said up to 12% of body weight was lost, analysts were expecting a little bit more, and that is something we always see happen to Novo Nordisk that will affect the share price. And now, given the drop on a forward P, they sit at 25.4, well below the 5-year of 38. In itself is potentially an undervaluation signal. Yield, however, of 0.93 is lower than what's typically offered at 1.2. And if we do take a look at the blue tunnel methodology, which here highlights the intrinsic value of the company, disparity between where it sits today and the bottom end. Remember, also nice to see intrinsic price increase over time, share price decrease. That is always where opportunities may arise. And also worth noting, when we zoom out to the last 5 years, this period of time has been the only time, in fact, since 2020, where the company's been trading severely undervalued. Prior to that, for the large part, it was in a severely overvalued area. Now, growth A+, love to see, 37% last year, 28% expected this year, well above the sector median in the mid to high single digit, and also much faster than their own 5-year average, with EPS projected 33% growth, again higher than what we've seen from both sector and their historical. Now, institutions, 83% ownership, selling $45 billion, buying a lot more at $128 billion, and we also see that in Q2, very bullish, and they've been net buyers for such a long time. If you want to see the reverse of the trend by quite some distance, you'd have to go to Q2 2023. Now, metrics for free cash flow per share we can see looking inconsistent year to year, but nice to note, anticipating massive growth in the next 12 months. Sales growth actually going the other way in the last few years, where some companies today, they've been decreasing. They're on an upward trend from 2022, 36% on a trailing 12-month basis, and they've more than doubled their top line over the last 10 years, whilst also doing some share buybacks on a year-on-year basis, but a little bit more inconsistent than perhaps one would like to see. No worries on the ROIC, very strong, 29% on a trailing 12-month, and has been increasing year-on-year. The same to be said on the operating margin, 18%, now at 41%. Love to note that. Free cash flow leaves a little bit to be desired. Last few years have really been lacking. We want to see it back in the numbers we saw previously. Net debt to EBITDA, a little bit higher than we would like, even though below 3 is really the threshold. Hopefully we see them drop to 1.1 as they anticipate in the next 12 months. Now, our intrinsic value, $691, is derived using a growth rate of 35%. Baked in right now is 34%, very high, but this is a company that has historically grown at a very rapid rate. If you believe this is too much, well, at 30%, there's downside of 24%. So using the middle rate of 35, in terms of a margin of safety, 5% would be a buy at 657, 10% not quite there yet. So Eli Lilly, 5 to 10%. Wall Street still very bullish, more than $1,000 into next year. 58% upside. Now, we'll also highlight, as this is what Wall Street believes growth will be moving forwards, or in fact slightly above, at 40%, 958, not too dissimilar from their forecast next year. You are ultimately getting a much larger margin of safety, as you would expect given the growth rate, but they see, as we keep on going, somewhere between 30 to 35% MOS today. Eli Lilly, let us know, similar to others prior, buy, hold, or avoid. And don't forget, as always, to sign up to the free weekly newsletter, grab those spreadsheets, come and join us at Patreon, where we cover our buys and sells. And as always, have a great day. We'll see you all on the next one.